Hello, investors. It's Don Vandenbord, Senior Portfolio Manager with Revere Asset Management. Today is Monday, December 12th, 5:10 p.m. Eastern Time, coming to you from St. Augustine Beach, Florida, with tonight's Revere Market Insight video. State of the market will possibly change tomorrow and Wednesday and Thursday, or maybe not at all, or maybe all three, based on what we've been seeing lately with the indexes playing ping pong around the 21-day exponential moving average. State of the market, still a fading bear market rally, less fading today, more fading on Friday, less fading last Thursday, more fading last Wednesday. Do you get what I'm kind of getting at here? The market has been all over the place waiting for some direction, and that direction will come from inflation data and from the Fed. Let's check the trend gauge over here. Market leaders neutral, short term neutral. We've got a split tape here. We've got the large cap indexes regaining their 21-day moving average today. Mid caps closing right on it, small caps below it. All five above the 50-day moving average. That's our medium-term indicator, and also varied versus the long-term 200-day moving average. We've got the Dow above it, mid caps above it, the other three below it. So what happened today? Started out as just your normal, average, boring day, waiting for some key data in the morning, and then we broke out above the 39.50 range, and then we based a little higher, and then we broke out above 39.62, and then we squeezed into the close. So nice afternoon move higher before CPI in the morning. Really, if you're looking at the 21-day moving average, and we pay a lot of attention to that, it's the fourth day above, below, going all over the place. We're looking for some clarification tomorrow. Let's see if we get it. Here are the numbers on the day. G6, this is our 6 ETF composite of growth ETFs, up 1.6%, S&P up 1.4%, NASDAQ 100 up 1.3%, Dow led up 1.6%, mid caps up 1%, Russell 2000 up 1.2%, global diversified 60/40 stock bond up 0.52%, in-house GROTECTION up 0.45%. Our beta was about a 5. Some of our holdings outperformed on Friday, underperformed today. That's what accounts for the difference. If you were a pure 50% 0.5 beta and it was all in the S&P 500, the move would be direct. But whether or not the individual holdings outperform or underperform dictates the difference relative to the S&P 500. We'll go through the tail of the tape, and then something I want to look at. 10 inflection points tomorrow and Wednesday, undoubtedly going to be an inflection point. Let's look at 10 prior inflection points related to the FOMC, Powell, or CPI, and the action in the days leading up to them, to see if we can come to any conclusions. We'll see when we get there. Let's get into what we do here at Revere. Active portfolio management. We take a look at the overall health of the market as dictated by the action of the 5 major indexes and leading stocks, and then we gauge it against 3 time frames. Short term, that's the green line. Medium term, the red line, that's the 50-day. The green line is the 21-day. Long term, the 200-day. When we're trending above all 3 nicely, we'll be pretty much fully allocated to the market. We start breaking below the moving averages, we'll take some off because our stops will get hit. If the slope of the moving averages roll over, that tells us a correction might be a little more than just a normal pullback. But if we break below the 200-day moving average, this is when we really get to a maximum defensive posture, and that's because all bear markets occur under the 200-day moving average. Now, you can be under the 200-day and just lose a drawdown. Normal drawdown is about 12% off the high until you break the 200. Sometimes you just go down another couple percent and then reclaim it. Sometimes it's a regular bear market, you're down around 20%. Sometimes it's a little harsher. We've got the severe ones highlighted. You got to avoid the severe ones when you're approaching retirement. You can't watch half of your nest egg disappear because of a negative sequence of returns. Sequence of returns is the different return every year that you get from the S&P, it averages between 8 and 9%, but you don't get that every year. You can get some very big variables, and you do not want to suffer through a 50 or 57% drawdown. This year, top to bottom, we had a 27.5% drawdown. Takes 38% to get even. We're chipping away at that now. Tomorrow could go a long way toward deciding whether or not we chip away more at it or whether we get a fourth leg down in the market. As you can see here, tentatively, about a week and a half now below the 200-day moving average after getting the bulls all lathered up with Jerome Powell dovish speech a week and a half ago. 3 closes above, gave it up. Trying to get some of that back today. Let's blow this up a little bit. And you can see 2 closes below the 21, back above, back below, back above, just playing ping pong. The slope of the moving average is flat, so that offers no insight. But, and we're going to, when we go through these inflection points after we do the tail of the tape, I want you to notice something. Where are we relative to overbought or oversold, and what have we done leading up to this inflection point? That goes a lot to do with it, in my opinion, because let me draw a line here right around 3,900. And once the market decided it was rolling over, this beginning of the second leg down on 421, this was the first inflection point. Anytime we've gotten extended more than around 10% maximum against 39.50, we snap back to it. So you can see we pull back to it, undercut it a little bit, get a little bit above it, pull back toward it, go underneath it, right back into it, can't get above it, go sideways for a little while. Oh, let's start to rally. Okay, we get up to 4,300, 400 points basically above. Less than 10% time to pull back. We pull back right to it. Can we rally again? No, let's go below it. 3,500. 450 points below it. That's a little more than 10%. Time for a rally. And this was on a big negative CPI day, but leading up to it, we had this leg down, a little bounce, 5 days down. You just can't get too far extended to the downside. What the institutions are doing is looking at the earnings projected forward for the S&P 500 and assigning a multiple to it. And when you get too extended one way or the other to that multiple, we're snapping back. And that 39.50 right now, which is basically where we've been for the last 4 weeks. If you'll look at that, that's where we start snapping back to right now. Interestingly, we're right at 39.50 now. So let's see if we break, which way we break, higher or lower. We may break one way on Tuesday and another day on Wednesday, depending on what Jay Powell says and what the data says. But for right now, we're right at it, and we just hooked up off of oversold on the stochastics. We'll compare those metrics to the other 10 points, the other 10 inflection points when we go forward. So let's go to the NASDAQ 100 now, QQQ, back above the 21. I'm going to rush through this kind of because these inflection points are going to take a little bit of time. Dow Jones Industrial Average, back above the 21, also playing ping pong. Only one close below, though, still the strongest of the moving averages. MDY, mid caps, closed right on the 21. IWM, small caps, lagging. Look at the relative strength line, relative weakness, bounced at the 50-day, still below the declining 200-day. Real quick look at some other indexes. Equal weight S&P, bounced at the 200, back above the 21. Equal weight NASDAQ, QQEW, right below the 200-day, but held the 21. Let's go to the VIX. A lot of VIX with a big bounce up today in preparation for what's going on tomorrow. Rare that you see the VIX up and the market up. Usually the VIX drops when the market's up and vice versa, but right into this neutral 24 to 26 area, back above the 21-day exponential moving average. Let's look at the US dollar. It started lower, ended higher, pulled back a little bit from the highs, but still in this extremely tight 8-day range here. Let's see if that resolves tomorrow and what that tells us. How about interest rates? Let's take a look at this chart really quickly on a 5-minute and tell me if you can tell where the weak bond auction occurred today. The 10-year bond auction was deemed weak, and interest rates popped. That means not enough of a demand for bonds. There's some kind of a bid ratio that they use toward the amount they were selling versus what institutions were wanting to buy. And the result was a big spike up in interest rates. The market initially came off, but very strongly reclaimed the losses. And then you can see us flagging out into the close. If you look at BND, price down, volume in yield up. So you can see the move down and then just going sideways. Let's take a look at the 30-year. TYX, same thing, spiked up and coming off of oversold. Another thing to pay attention to. Dollar and bonds oversold, but coming off of that. Gold lagged today. With the dollar up, pulled back. It's been riding this ADMA, can't get back above the 200-day moving average. Are there any other key ones that I did not do? How about junk bonds? Junk bonds continue to go higher, showing no fear in the credit markets. I'm not even going to look at Bitcoin because it's basically doing nothing. It's in a risk neutral position, hanging right around 16,000, waiting for this FTX, any fallout to that to continue to come to the surface, and also to see whether the markets go to risk on or risk off. Let's go to silver, as this had been leading. Silver not down much at all today, pretty decent day for it. How about gold and silver stocks? GDX bounced off the 21. So let's get to the tail of the tape, and then we'll get to the inflection points. So the stochastics, all of them hooked up. They're still below the moving average, but they're near oversold and hooked up. That's a positive for the market. NASI RSI still negative. Oversold still on the dollar, coming off of oversold on the TNX and TYX. That's interest rates. Put call 103, VIX, I already mentioned, up big today, fear and greed out of 59. We'll decide tomorrow, I imagine, if this will go back to green or if the bear case is going to take over. Some news. The S&P 500 E-mini futures rolled. There's a contract roll every 3 months. And there's a 35-point premium right now against the S&P 500. So, for example, the S&P 500 closed at 39.90. The ES closed at 40.25, which is really weird from a technical analysis standpoint. And if you hear somebody talking about the S&P, you got to clarify whether or not they're talking about the ES or the S&P. 35-point premium right now. I mentioned at 1 o'clock the week bond auction yields popped. Day count from down 1 to up 1, CPI at 8:30 tomorrow, then FOMC Wednesday at 2 o'clock. Expectations neutral coming in, just playing ping pong versus the 21. Nothing really changed. Basically, we popped back to where we were pre-market on Friday before the PPI data came out, and then we dropped immediately 1% below where we were, from up 0.5% on the futures to down 0.5% on the futures. Levels, we reclaimed this 39.50, 39.60 regression area. NASDAQ 100 between support and resistance. Note no red arrows today at all. Complete opposite of the close on Friday. Opened up 0.2, based, broke out above 39.50, based, broke out above 39.62, and then just trended higher into the close up to 39.90. Here's all the various changes on the day. The sectors that led: semiconductors, definitely, there's 6 of them on the 21 over 21 list now, from the 3 different main semiconductor classifications. Started the day weak, ended the day strong. Always keep an eye out for when that's happening. Bond prices, as I said, started higher, ended up lower, which takes the yields higher. Weakness today in emerging markets: gold, silver, and gold and silver stocks, and stop me if you heard this before, marijuana stocks. Here's our focus list. We're not going to go through the portfolio today because I want to go through the inflection points. I do want to note that GFS was added to the NASDAQ 100. That's something that was initially on our 21-21 list and fell off, but nice volume and a move back above the 21 today. My favorite combination is back above the 21 and a move off of oversold. Didn't buy it today, would have, but didn't because we've got a binary event tomorrow. So no trades today. Portfolio came in at 0.5, ends up slightly up because of the increased sizes and the portfolio holdings that we have. So from 0.5 to 0.53. Bottom line, afternoon move higher before CPI in the morning. 4th day, down up versus the 21. same spot, same quotes for support and resistance, 200-day all the way down to 40.35 now, so less than 1% away from that now. Let's move on to these inflection points. I think this is important. The first one, we're going to go S&P 500. We're going to note where we were leading up to it versus on the stochastic, and what was the action leading up to it. So the first one was on 421. We've talked about this forever, kind of just going sideways leading up to it. It was Powell gave a very hawkish speech the day before, really nothing to glean from it, but an ugly day down on 421, and that began the second leg down. That day we were down 1.5% of the news. The second inflection point was also FOMC. It was 5, 4, and 5, 5. Now, the strange thing about this is that we rallied strongly into the close after the speech, and then we sold down 5 of the next 6 days. Hard. So what we did in the afternoon did not give a clue as to what was going on prior to that. The days leading up to it, really just a consolidation into that. So nothing really can be drawn from that. CPI 6, 9, 10, and 13 is the next one. That's right here. I remember the very tight range that we had, but the day before CPI, we broke down 2.4%. And then the day of CPI, it was announced down another 2.1. This was a Friday. The next day on a Monday, a lot of institutions thought about it, and it gapped down again, and we ended up down 3.9%. This was really the meat of the move down before we started getting too far extended from 39.50. We got down to 39.36. You can see this move down. This is why we don't shorten the whole. A lot of people think that when you make a lower low, you short. No, you got to look at where you were prior to that and where are you on the stochastic. So going back here on the stochastic, we were already oversold. On this one, we were already oversold. On this one, we came off of oversold and we're up closer to overbought. So you've got more room to move down because of where you are relative to where you're going, if that makes sense. Okay, next up. Powell spoke and talked about, this was his "there's going to be some pain" speech. This was on 8/29. We based nicely here. This was the strongest rally of the year, trended very nicely above the ADMA. Then on 8/26, Powell gave a speech saying there's going to be some pain. And the day before, we just consolidated for 4 days. We're coming down off of overbought, still not in oversold, and then we went oversold on that speech, 8/26. So consolidated before it, big move down. Didn't go too much further down though, because we were already near oversold. Then a little bit of a bounce here. This was a very interesting day. We went down. This is the next inflection point. This was CPI missed. It was a big miss on 9/13. That's this day right here. So notice into CPI, Powell said there's going to be some pain. We come down 4 days up, coming off of oversold, headed higher. CPI big miss. Since you're headed higher, there's room to go down. We did go down 4.3%. After a 4-day rally, you can expect a pretty decent move one way in the opposite direction. What I wouldn't have expected is a big move higher, because we were already coming off oversold and after 4 days up. But anyway, that was the beginning of the second part of this third leg down as of right now. Next up was FOMC. It was Jackson Hole. Jackson Hole was. We had the CPI big miss. The Jackson Hole speech was the some pain speech. Then we had the big CPI miss. Then we had FOMC on 9/21. Let's go forward here to 9/21. Here's the move down on the CPI miss. Here's Powell saying the message has not changed since Jackson Hole. We went a little bit further lower, not a whole lot lower, because we were already oversold. And we consolidated for the 3 days prior moving into it. But enough to get us pretty far extended down from 3,900 that, could we really go much lower? 2-day snapback, consolidation, and then the next inflection point is on 1013. This was a huge CPI miss. The initial was a gap down. I remember our morning call, Alex, saying it looks very bearish right now, but remember, we've been down 5 straight days and we're approaching oversold. Can we really go down a whole lot more? We did gap down about 2.5%, and like a slingshot, 5% move from the low to the high that day. And that put in the initial bottom right now, and it was on bad news that the oversold or that the bottom got put in. Then we started the first leg of this most recent rally that we have now. So that was the 1013 inflection point. Next up was 1112 when the Fed statement was dovish. Which day was this? It was 11/2. Fast forward to 11/2 here. This was when the Fed statement was FOMC day. The Fed statement was dovish. We initially gapped higher, and then we sold off into the close because Powell started speaking and he started becoming very hawkish. Where were we coming into that? We were coming off of overbought, so we've got room to move. And we consolidated sideways for 3 days, so there was no major move in the prior direction. So move down started us toward overbought, but remember we had this big inflection point back here. We're still below 39.50. If we'd have thought we were going to go lower, all we did was go lower for another day after 11.2. And then we started rallying higher, and then 11.9, then we've got 11.10. CPI came out. That's the last CPI, and it gave positive inflation news. So you can see the big move up. What we were doing here, where were we? We're halfway between overbought and oversold, so basically neutral. We had gone nowhere for the 5 days prior, so a pretty strong move up, 5.5%. I remember when it came out, we immediately moved 3% off of where we were pre-market. We went higher. We only went higher for 1 day as we went right around 39.50 below the 200-day moving average, and we started heading toward overbought. We've only been overbought 1, 2, 3, 4, 5 times during this entire year. And when we get there, we spent a whole lot more time on oversold because it's a bear market than we have on overbought. You can see how very clearly with us staying overbought here that this was the strongest move. This one just going up, then coming down, then going back up again. This was a big shakeout in the middle of it. And now basically we've gone nowhere for 1, 2, 3, 4 weeks. 3 of the weeks spent in overbought before this hard sell-off last week, after we faked everybody out above the 200-day moving average. Think about that. We're already overbought, and we got above the 200-day moving average. Can we go much further? Well, if we're kicking off a big bull market, maybe we can. But the most time we spent here has been 3 weeks oversold. Here it was, or overbought. Here it was 1, 2, 3, 4, 5 weeks. So in hindsight, while I was bullish, I really shouldn't have been surprised as much that we then sold off for 4 straight days after this 11:30 inflection point. This was the Powell speech at the Brookings Institute, where he came off as very dovish. And then we had the jobs report on 12/2, 2 days later. We were weak early in the day, and then we recovered. But then the following Monday and Tuesday is when we had the 2-day sell-off. And then here's Friday with PPI. Was it an inflection point? Not really looking like it. We were 0.5% above the PPI data. We went to 0.5% down, but we really didn't progress any further. And now here we are on, wait a minute, let me check PPI last week. PPI, yeah, that was on Friday. Didn't go, so we really didn't go any further down. We already came in a matter of 5-6 days from overbought all the way down near oversold. So where are we now going into tomorrow? Well, we've got a 5-day consolidation. We're basically exactly where we were on 12/5, okay, a week before that. And we're just bounced. We had a stochastic cross going higher. I don't know which way we're going, but I'm putting the odds in the favor that if we go lower, it probably wouldn't be substantially lower. It could be if the inflation number is very high. But note, prior to this, we've gone nowhere for basically 1, 2, 3, 4.5 weeks. We've gone nowhere for the last 5 days, and we just bounced when we reached oversold leading into it. To me, this is more of a bullish setup than it is a bearish setup, but I will go with whatever direction the market mentions. I would feel a lot. I feel frankly better at where we are now than if we had still been up here on overbought and waiting for the inflation data. Very similar to the complete opposite of what happened here on 10/13 when the data was terrible, but we already had this big second leg down. We just couldn't go down any further after spending all this time in oversold, and that put in the bottom, and then we started to slingshot higher from there. Remembering we also have two big back-to-back inflection points. So what we see on Tuesday, we then have to wait until 2 o'clock Wednesday afternoon Eastern time to see what the reaction is going to be to the FOMC, and then we've got the statement and the press conference. So that should be a couple of really fun hours in the afternoon on Wednesday. But I kind of like the fact that we're a little closer to oversold right now than we were to overbought, knowing that we can stay there. But looking at these other 10 inflection points and where we were leading up to them, it just gives you a little bit of an indication of leaning the odds maybe 60-40 one way instead of just a 50-50 binary event. Not that that's a good sign, but I just wanted to, I report, you decide. Okay, let's go with that. But anyway, those 10 prior inflection points, 1, 2, 3, 4 of them, nothing significant. Down inflection point leading up to it, down one time, up twice, and down one of the inflection points. 3 of the inflection points went higher. The 10/13 we went higher. 11:10 we went higher. 11:30 we went higher. In all 3 cases, we were negative the day before, down 6% leading into 10/13 when we were up 2.6%. That was on CPI, and then on 11:10, CPI showed inflation weakening. We were down 2.1% prior to that. We rallied big time, 5.5% leading into that. And then on 11:30 with the Powell speech to the Brookings Institute, but that was 2 days before the job report and the delayed reaction to that jobs report. But we were down 1.6% on that and up 3% on that day. So 3.2% delay reaction on 12/5 and 12/6 after the 12/2 jobs report. I hope I've thoroughly confused you. No, that's not true. It was interesting going through the exercise, looking at the different inflection points, seeing where we were leading up to them, seeing if we had made a move in any one direction leading into it. The most telling one was this negative, big negative reaction news that resulted in the slingshot higher when we just got too far extended against 39.50 to the downside. That 39.50 plus or minus 10% has been kind of critical on the upside and the downside. That doesn't give us any insight right now because basically we're right at 39.50, and we've been at 39.50 for the better part of 5 weeks now. So just going sideways is the bottom line. But during that sideways, we've gone from overbought to neutral, back to overbought, and now back to oversold with a little hookup. And that's going to wrap it. As always, love to hear from you. If you want to review these points yourself, be my guest. Maybe you can see something that I didn't. I'd love to hear it if you did. But the email to reach out to me is don@revereasset.com. The phone is 855-REAL-WEALTH. That's 855-732-5932. Remember, it's not how much you make in the market, it's how much you keep. We're basically half invested from a risk perspective versus the S&P 500 going into tomorrow. We'll take our clues from the market to whether or not it's time to put the gas pedal down or apply the brake pedal. I would say based on where we are and what we see leaning into it, it's probably 60-40 in the direction of bullish versus bearish, but 60-40 isn't overly great odds. So, and besides, we generally don't predict here at Revere anyway. So, wrapping up Monday, December 12th, this is Don Vandenbord presenting the facts, presenting what happened leading into the last 10 inflection points, as we've got two major ones back to back this week. As always, the market is incredibly interesting, and without a doubt, there will be a big bull on the other end of this tunnel that we're in right now, and we'll be ready to compound our capital because we've done a fairly good job protecting it throughout the year. So thanks for listening and have a great day.